For decades, thousands of people believed they had found an almost perfect way to get rich. Buy a shopping mall, lease out its stores, and collect rent every month while doing practically nothing. It seemed like a passive income machine. But behind many properties valued at millions of dollars lies a hidden problem capable of turning an apparently safe investment into a massive loss. And many owners do not discover it until it is already too late. Because before you make a single dollar, you first have to survive the purchase. Building a large shopping mall can cost hundreds of millions of dollars before the first store even opens. The land alone may be worth tens of millions. Then come the concrete, steel, electrical wiring, climate control systems, parking lots, permits, and safety regulations. By opening day, you may have spent more than it would cost to build a small hospital. Buying an existing mall seems easier. But this is where the first surprise appears. Two similar shopping malls can be worth completely different amounts. Class A malls attract prestigious brands, generate strong sales, have businesses waiting to move in, and are located in neighborhoods with high purchasing power. In the best cases, they can be worth more than $1 billion because their income is stable. At the other end of the spectrum are older buildings with weak anchor stores and fewer shoppers. Some eventually sell for only a fraction of what they originally cost. Rolling Acres Mall in Akron once had more than 140 stores. Its former owner paid more than $33 million for it. Years later, it sold for $2,750,000, and then for less than $2 million. Even so, it continued losing businesses. That is the first truth nobody tells you. You are not simply buying a building. You are betting on the neighborhood surrounding it. And the price reveals just how dangerous that bet may be. That is why major property owners do not risk everything on a single location. Many operate through REITs, or real estate investment trusts. Companies that own dozens of properties and are legally required to distribute nearly all of their profits to shareholders in exchange for not paying corporate taxes on that income. Any investor can purchase shares for a relatively small amount of money, while the risk of one struggling shopping mall is spread across a much larger portfolio. That is very different from a private buyer who puts all of their capital into one building in one city. But let us assume you have already found a mall at a good price. Before collecting your first rent payment, you may inherit three invisible problems. The first is the anchor store lease agreements. Many were signed decades ago, charge extremely low rents, and preserve those terms for years. When you buy the building, you also inherit every good or bad agreement made by the previous owner. The second problem is deferred maintenance, leaking roofs, worn-out climate control systems, cracked parking lots, and elevators and escalators that need repairs. If the previous owner cut expenses to make profits look better, the truth will appear after the purchase in the form of an enormous bill. The third problem is the most dangerous, co-tenancy clauses. If an anchor store closes, these clauses may allow other businesses to pay lower rent or even terminate their leases. The cost does not appear when you sign the purchase agreement. It appears when a major store leaves, and, suddenly, a dozen tenants are allowed to pay you less or stop paying altogether. That is the real trap. A shopping mall may look completely full on the day you buy it, but losing one single piece can change its entire financial structure. However, this creates a contradiction. If anchor stores represent such a major risk, why do they receive such favorable terms? To understand that, you need to see how a shopping mall actually makes money. The first layer is base rent. In a high-end mall, a small store may pay between $40 and $60 per square foot each year. An anchor store pays much less. Before the company went bankrupt, some Sears locations were paying close to $5 per square foot, while smaller businesses were paying around $50 or $60. Think about that. The largest store in the mall could pay almost 10 times less than the clothing store next door. Why would an owner accept that? Because an anchor store does not pay only with money. It pays with its name and the customer traffic it generates. It attracts shoppers who, on their way to the anchor store, walk past dozens of smaller businesses. The owner offers it a low rent because they are not simply leasing square footage. They are buying foot traffic. And that is only the first layer of income. The other businesses ultimately finance that discount because they pay full price to be located near the attraction generating all that traffic. The second layer of income is percentage rent. In addition to base rent, some stores give the mall a percentage of their sales after exceeding an agreed threshold. For example, if the breakpoint is $1,500,000 and the business generates $2 million in sales, the property owner may receive between 6 and 7% of the additional $500,000. When the store sells more, the mall earns more as well. The third layer is common area maintenance, commonly known as CAM. Businesses do not only pay to occupy a store, they also cover a proportional share of the cleaning, lighting, security, parking, and escalator costs. If one store occupies 10% of the space, it pays approximately 10% of those expenses. This means that a significant portion of the building's physical operating costs is passed directly on to the tenants. The fourth source of income comes from everything that does not look like a traditional store. Parking fees, advertising, temporary events, seasonal markets, photo booths, and kiosks installed throughout the hallways. These small stands occupy very little space, but they can pay extremely high rents because they are located in the areas with the most foot traffic. A kiosk measuring less than 100 square feet may be worth more per square foot than an entire store located against a wall. In this business, size does not always determine price. Location is worth more than space. Up to this point, the shopping mall appears to be a machine generating money from 4 different directions at the same time. But now comes the other side of the equation: expenses. Keeping more than 1 million square feet lit, climate controlled, and operational throughout the entire year can cost hundreds of thousands of dollars every month. On top of that comes security, cleaning, landscaping, repairs, property taxes, insurance, and the loan used to purchase the property. And within CAM expenses, there is one dangerous detail. Those costs do not disappear when stores close. The hallways still need to be cleaned, the lights continue consuming electricity, and security still has to patrol the entire building. As the number of vacant stores increases, the same expenses must be divided among fewer businesses. The stores that remain end up paying more, and that pressure can force the weakest tenants to leave. That is how a cycle begins that is extremely difficult to stop. Fewer stores generate less income, costs increase for the tenants that remain, and that causes even more businesses to close. But there is an even more counterintuitive trap. A shopping mall can appear full and still be losing money. What matters is not only how many stores are occupied, but also who is paying a profitable rent. A property may report 90% occupancy, but if much of its space is occupied by anchor stores paying very little, and the smaller businesses are only staying because of discounted, temporary leases, the actual cash flow may be far weaker than it appears. Occupancy is not the same as revenue, and that difference is where many property owners begin to face serious problems. But before examining how a shopping mall dies, we need to understand why these buildings were designed this way in the first place. The earliest developers studied how people moved and built everything around that behavior. They placed anchor stores at opposite ends of the property, forcing shoppers to walk through long hallways and pass dozens of businesses along the way. They placed escalators and elevators away from the center to extend the journey even further. They even combined skylights with artificial lighting to make it harder for people to notice how long they had been inside. None of this was merely decorative. Every decision was designed to increase the number of storefronts shoppers saw before reaching their destination. That is the business logic of a shopping mall summarized in one simple idea. Force people to keep moving and you increase exposure. And that exposure is what small stores are really buying when they pay rent. Now comes the structural risk that runs through this entire business. For much of the 20th century, department stores such as Sears were the backbone of shopping malls. Many projects did not even begin until 1 or 2 anchor stores had been secured, because banks were unwilling to finance them without a guarantee of consistent foot traffic. But after the year 2000, and especially after 2010, those stores began closing rapidly. Sears, which once operated nearly 4,000 locations, filed for bankruptcy in 2018. The problem was much greater than simply losing one store. Approximately 80% of its locations were inside regional shopping malls, and some of the largest property owners had Sears stores in dozens of their properties. Remember the co-tenancy clauses. When an anchor store closes, other businesses may be allowed to pay lower rent or terminate their leases. As a result, one single departure can reduce the income of the entire building. Replacing that space is not easy either. Former department stores occupy enormous areas, with loading zones and layouts that are difficult to adapt. One property owner spent $100 million and 3 years simply dividing one of them into 4 separate retail spaces. Now imagine repeating that process across dozens of shopping malls at the same time. That is why the Sears bankruptcy was not a problem that lasted only a few months. It was a wound capable of remaining open for years. This is the structural truth of the industry. A shopping mall does not need every business inside it to fail. It only takes the disappearance of one major piece that everything else was quietly depending on. To see how this happens, let us return to Rolling Acres Mall. It opened in Akron, Ohio, in 1975, with Sears and approximately 20 other businesses. Within a few years, it had grown to more than 140 stores, 5 anchor stores, a movie theater, and a food court. During the 1990s, it was one of the busiest shopping destinations in the region and reached an occupancy rate of nearly 98%. It appeared almost invincible. But then the pieces began to disappear. A newer shopping mall opened nearby and began attracting shoppers. Target relocated. Dillard's closed. Another department store changed its name twice before leaving because of poor sales. By 2006, occupancy had fallen, and the building that had once been worth more than $30 million ended up selling for only $1,600,000. The interior of the mall closed in 2008. Sears held on until 2011, and the final business, a JCPenney outlet, closed in 2013. From that point forward, the building stood empty. But that was when the most expensive part began. People entered the property to remove copper wiring and anything else of value. Vandals destroyed the skylights, allowing rain and snow to slowly rot the floors and ceilings. The owners stopped paying property taxes and accumulated more than $1 million in debt until the city was forced to intervene. The shopping mall was eventually demolished in stages between 2016 and 2019. Later, Amazon built a distribution center on the same land. That detail summarizes the entire story. Rolling Acres went from 98% occupancy to a pile of rubble and then became a warehouse for the company that symbolizes the new way people shop. And it did not happen because of one single disaster. It was a sequence of smaller problems, with each one making the next more likely. Fewer anchor stores, fewer shoppers, lower sales, more vacant spaces, and higher costs for the businesses that remained. But the collapse of Sears and shopping malls such as Rolling Acres did not happen in isolation. At the same time, online shopping began capturing an increasingly large share of consumer spending. For decades, the real product offered by a shopping mall was not simply its collection of stores. It was convenience. If someone wanted to compare several shoe brands in one afternoon, the mall was almost the only place where they could do it in a single trip. That advantage justified driving there, searching for a parking space, and walking through long hallways. The internet destroyed that monopoly. A person can now compare hundreds of options from their couch, have them delivered within 1 or 2 days, and avoid traffic, parking, long walks, and checkout lines. The convenience that once made shopping malls essential no longer belonged exclusively to them. And when that advantage disappeared, the weakest malls discovered that the building itself had never been enough to keep the business alive. The convenience that had made shopping malls indispensable was no longer exclusive. And the malls that suffered the most were those trapped in the middle of the market. They were not exclusive enough to offer an experience that could not be found online, nor were they inexpensive enough to compete with discount stores. Weak shopping malls, especially those experiencing financial problems or located in declining areas, were hit first. The strong became stronger, while the weak became even weaker. To survive, property owners had to change what they were actually selling. Instead of filling vacant spaces with more clothing stores, they began looking for businesses that a screen could not replace. Restaurants, gyms, medical clinics, shared offices, movie theaters, and entertainment venues. Some even transformed entire wings into hotels or apartments, turning the shopping mall into a mixed-use property with multiple sources of income. The idea was simple, although expensive. In the past, they sold products. Now, they had to sell reasons for people to leave their homes. Reasons the internet could not deliver to their front doors. So, does owning a shopping mall truly work as a business? It depends entirely on which mall you own. In the positive scenario, the building is well located. The anchor stores still generate foot traffic. There is a healthy combination of restaurants, services, and retail businesses, and very few spaces are vacant. Base rents, percentages of store sales, and common area maintenance payments generate consistent income, while the property's value may increase if the surrounding neighborhood continues to grow. That is the version of the business that turned major property owners and developers into some of the wealthiest figures in the real estate market. But in the negative scenario, an anchor store closes and everything changes. Co-tenancy clauses are triggered. Some businesses renegotiate their rents and others leave. Meanwhile, electricity, insurance, and property taxes continue to increase because those expenses depend on the size of the building, not on how many stores remain open. The enormous vacant space may remain empty for years without generating any income, but it still requires security, maintenance, and insurance. In addition, common area expenses must be divided among fewer businesses, meaning those that decide to stay end up paying more to keep the lights on in hallways where fewer and fewer people are walking. The difference between these two scenarios can separate a growing asset from a property heading toward the same fate as rolling acres. And these are not opposing theories. Both scenarios can occur in the same building within only a few years. Rolling Acres experienced the positive version first. It was almost completely occupied, with 5 anchor stores, more than 100 businesses, and an important role within its community. Then it fell into the negative version and never managed to recover. The building was practically the same. What changed was the economy supporting it. From the outside, a shopping mall looks like a building filled with stores. From the inside, it is an interconnected financial system in which the future of every business quietly depends on the others. An anchor store does not simply sell clothing or appliances. It also provides the flow of people that smaller businesses depend on to survive. When it disappears, it does not leave behind only an empty retail space. It removes part of the financial foundation supporting the entire building. Because the real business is not owning walls, hallways, or parking lots. The real business is the people walking through them.